Okay, thanks Graham, and very good afternoon to you all. Hopefully this will be interesting. It's been some very, very interesting times in the marketplace of late. There have been some phenomenal stocks. I do know that from a couple of presentations that I gave. If you happened to be on Farm Pride Foods at 40 cents, that's the egg company, you'd be worth $1.70 today, and that's in less than 6 months. There are some other good ideas out there, but it's been the behemoth, banks and resource companies that have been actually weighing on our markets, but we'll touch on that in a moment. Okay, let's have a look. The International Year of the Monkey. Great unexpected fortune will find its way to monkeys in 2016. Well, there you go. The best months for them to make their fortune will be the 2nd and 12th Chinese lunar months, so that is going to be March and January next year, during which they should make full use of their time to invest. They should avoid gambling, speculating and collecting illegal or greedy gains. So care would be perfect for you if you are a monkey. They will lose everything, they will lose everything they have, especially in the 3rd Chinese lunar month, which is April of this year. Maybe it coincides with April Fool's Day. They should also guard against becoming poor due to greed. There you go. So monkeys should not show off their wealth, or they will be persecuted by others. So there you go. That's the first bit of what you need to take away for 2016. When we last met, for the ones of you who I've spoken to in the recent past, I made mention to you that China, whilst the trade surplus, which is their exports minus their imports, was going to boost GDP, the fact that their imports were actually going lower and lower didn't bode well for the underlying momentum of the economy. And guess what? It hasn't done real well, but it's not falling off a cliff. We'll touch on that in a moment. The other thing I mentioned was that manufacturing index in China was below 50, and that means that it was contracting. Again, it's caused a lot of nervousness in the marketplace at the moment. The other thing I said was that US would lift interest rates. It was a fait accompli, but in my humble opinion, it was a mistake to do it. And that was because, and I'll touch on it in a couple of slides' time just to refresh your memories, the reason why it was a mistake to do it was because the US economy was already slowing. In the last quarter of last year, it was already coming off the boil. And so when it raised interest rates and also gave a bad signal to the marketplace, the markets started getting very, very nervous because it wasn't required. Again, we'll have a look at an update on that in a couple of slides' time. Australia would sputter, and it is still sputtering. We're not going into recession. No one feels as if we're going into recession, but we're sputtering along at something well below trend growth. And finally, European and Japanese growth was cyclical in nature, not structural. Now, when I say structural, it's all good health and it's good there for the long term and all the rest of it. This was just because they had pumped a whole lot of money into their economy. We were starting to get a bit of an uplift. I still have the opinion that that it's a cyclical bounce, and it's not structural, not by any means at this point in time. Hopefully you can see that ship. It looks like a few containers are going to end up in the bottom of the ocean. Is China in for a recession? Well, look, a lot of people are saying that that basically it is, and it's all bad news and doom and gloom. And they say, well, don't look at the GDP numbers, because the GDP numbers, they're always coming out at exactly what the authorities predict. So if they say it's 8% that we're going to try and grow, they'll be 8.1 or 7.9. It'll be very close to 8. And so these commentators are saying, look at electricity production or look at railway freight, because these are closer indicators of what's really happening in the economy. Unfortunately, as we have progressed down the track of growth in China, a lot of these electricity production, railway freight relates to heavy industry, and that doesn't necessarily reflect the broader economy. About 40% of the Chinese GDP now accounts for less than 20% of the stock market. Okay? So it's changing. Don't get stuck in the old way of thinking. Look at the new way of the world changing. If I look at what their policies have done to date, because the government has stepped in, it wasn't going to sit idly by and watch the economy, as I said, slow down to the point where it could recess. I'm looking at car sales at the moment, which are up 25%. There are more cars sold in China every year than there are in America. Government spending is now growing at somewhere close to 20%, which is boosting GDP. And where initial public offerings, so that's new companies listing on the stock market, in China had almost ground to a complete halt, they're actually now starting to resume, which means capital is flowing freely throughout the economy. This is what growth looks like. Hopefully you can see this from the back of the room. That it's slowing, but the economy is getting bigger. You cannot keep growing at 10% every single year as your economy doubles, because it's the rate of change in numbers has to become absolutely huge. What we'll find is at some point in time, and just for what it's worth, at 7.25%, your economy will compound to be worth double in about 10 years, as you know the calculation. So if you have been growing for a number of years at 10% per annum, every 7 years your economy is double. We've been going for about 20 to 25 years worth of these 10% growth numbers in China. It's time that these numbers start to look a little bit smaller. How much smaller? Well, that's just the course of how we're going to be looking over the next little while. I think that by the end of next year, we should be down to somewhere around that 6.5% level as being the new norm. That's the new norm. In terms of inflation, should we be worried that they're starting to ease monetary policy, that they're injecting a whole lot of dollars into the economy to try and boost it? Because obviously if you start to run far too fast, inflation starts to spark. But if you have a look at this chart here, price is only rising at sub 2% per annum. There's no real issue here on the inflation front. Just looking at the United States, we've got low growth over there and it's been caused by high debt. I've been rabbiting on about this one if you've been listening to me for a few years now, probably since the GFC. The economy in the US is going to struggle to grow above trend for at least the next 5 years, at least. It has got a mountain of debt that it has to come through. And so basically the way I see what's happening there is it's a handbrake on growth. It can't grow the same way it used to come out of recessions in the past. And so this is going to be a very drawn out recovery, and it's going to sputter along the way. And what we're seeing at the moment is a little bit of sputtering. Now, there are a couple of positives and a couple of negatives in terms of when I look at the economy. The positives are that we've now got lower oil prices. It's $2 a gallon for petrol. Equates to about 50 cents a litre here in Australia. That is putting a heck of a lot of pricing power back into consumers' pockets, right? Now, I'm a classic example of my car was costing me at $1.45 a litre of diesel. It was costing me somewhere in the vicinity of about $145 every time I filled up. Granted that I used to fill up every 2 weeks, but it was still costing $145. At the moment, I'm filling up for about $95. That's $50 every tank left in my pocket to do whatever I want with. Now, whether I put that on the mortgage or whether I put that towards a case of beer, it doesn't matter. Consumption is there for me to be had. It's not being spent where I really didn't want it to go, and that was effectively a tax on my living standard when the oil price rises, as it is around the world. Energy and capital expenditure, which had started coming off the ball. Now again, when you're looking at GDP, when you're looking at the way economies grow, sometimes when things get less bad, it's good. And what was getting less bad was the amount of decrease in the rate of spending on oil exploration, shale oils. Which was weighing, it was a dead weight on the economy for a little while. It's abated, so the economy starts to grow again. And finally, government spending. The government over there has been absolutely hamstrung to be able to spend because it's been running such large budget deficits, and the growth in the economy wasn't anywhere near as strong as it should have been, plus it had wars to fund. Well, look, where that has been a big drag on the economy in the past, it's actually abating. So instead of being a big negative, the abatement means the growth starts to pick up a little bit. Now, on the negative side, banks aren't lending anywhere near as much as they were. So if you can't invest because the bank's not giving you money, you can't grow. Assets, housing in particular, have gone up. They're not going up anymore. So basically, that's now acting as a headwind. And finally, debt is still far too high because they've robbed from the future to have growth back then. Now they've got to pay that debt off. And that is the debt that, if you've read the Magellan newsletter this month, he is talking about and constantly refers to as it is a real headwind. And it's going to continue to be a headwind, as I said before, for some time. This was the closest I could find to a monkey. It's Janet Yellen saying the Fed awakens. She has put up interest rates by 0.25%. I think, as I said to you, and for those of you that I've spoken to at the end of last year, that it was a mistake. As a rule of thumb, watch the currency. At zero interest rates, the only way that you can tell whether an economy is going to start growing or it's going to start shrinking is whether the currency has been going up or has been going down. Because at the zero interest rate bound, monetary policy can only be transmitted through currency. And the way that that feeds back into the economy is if your currency goes down, makes your exports cheaper, makes whatever you sell to the rest of the world cheaper, so the rest of the world will buy more of that. And that's what Japan, as I'll speak about in the next couple of slides, is embarking on right now by having negative interest rates, and it's going to have profound effects on Australia. But as a rule of thumb, generally in the economy, in the US economy, a 10% increase in the US dollar will reduce its growth by anywhere between 0.5% and 1% after 2 years. And I think this lag is the thing that the Federal Reserve missed. And so what we've seen is over the last, since April of 2014, we've had about a 19% increase in the US dollar across the board. So that's versus the, so that's the TWI, trade weighted index. It's against the US dollar, the Chinese yuan, the euro, the yuan, the yen, and so on and so forth. And so it related to about a 1.7% reduction in output. In other words, if you were expecting growth was going to be 2.5%, take 1.7% off that, you got 0.7%. Now, you may have heard me talking in the past that the Goldilocks growth number in America, that is where just right, not too hot, not too cold, just right, is about 2.5%. Now, why do we care if it's too hot? Well, if it's too hot, you get inflation. If it's too cold, you get unemployment. And we want to get to a steady state. So that steady state is somewhere around that 2.5%. Well, if you're expecting 2.5% and you've had a 19% increase in the currency, and now you're down at 0.8, unemployment naturally starts to rise. But what's been interesting is that we've had actually very strong employment in the US, but it's been underemployment because you're getting people like engineers and pharmacists and people with degrees, accountants and so on and so forth, basically in service sectors, flipping burgers. So they're underemployed, and when an opportunity opens up, you get them moving across, and then someone comes in and slides in at the bottom end. And it's filling this bottom end, which is what's showing up in the data as having this full employment. What's more important is actually to see what the wages component is doing of the US market. And wages aren't going up, meaning that there's no inflation anywhere to be had. And if you're getting underpaid, you're still struggling to pay your mortgage. And that's what I think, well, that's exactly what I'm seeing in the United States at the moment. For those of you who like pictures, here is what the US quarterly GDP growth looks like on an annualised basis, up and down very haphazard, but nowhere near the 2.5% that we should be at. This is the employment and unemployment line, the employment and non-farm payrolls line. As you can see here, the unemployment rate is down at 5%. That's the thick blue line on the left-hand scale. On the right-hand scale, they've been producing somewhere in the vicinity of about 200,000 jobs every single month. As I said, if you were to take this back to the 2000s, late 1999s, you would have found that people were asking for wages, and the price of labour was going through the roof at 1,000,000 miles an hour, causing inflation. Not at the moment. So for such good, strong growth in jobs, the fact that inflation isn't coming through is actually very interesting. Here it is in terms of prices. As I said to you before, the US Employment Cost Index, which is the dotted line here, 0.6%, running at a 0.6% per annum rate. Absolutely nowhere to be worried about. And then finally, just looking at the real inflation rate and the headline inflation rate. The headline inflation rate includes oil, and it's coming down. That's the blue line. The core inflation rate strips oil and strips volatile series out, like fruit if it's going up and down like a yo-yo. It's settling there at about somewhere around 2%. This is the reason why I say to you, don't be too concerned about the US. It's got enough, I guess, oil in the engine, being inflation, to run okay. So it'll be periods of stronger growth, lower growth, but generally it'll sputter along. I'll talk to you about the direction of the markets in a couple of slides' time. 2 days ago, the Australian market, and in fact the rest of the world's market, actually became incredibly elated that Japan surprised us and pushed its interest rates to negative 10 basis points. Now again, if you think about that, I'm going to give the Bank of Japan $100 today, and in a year's time they're going to give me back $99.90. That sounds like a good deal. Hopefully inflation's going to eat it away. Well, inflation is actually in the negative, so your money's still going to be buying more than what it does today. But the issue here, and what you guys need to understand, is that why would you hold yen if you're going to get a negative return on it? And you'd be pushing that yen into anywhere else in the world, which is called the yen carry trade, that you possibly can. And that yen carry trade, you will be aware, has been going on for, and you may have heard it as the world is turning Japanese. So Japan is actually dragging the rest of us down. And that's exactly what's going to happen now over the next year, as I see it, especially for Australian interest rates. Now, a friend of mine this morning, as I was getting on the plane, texted me and said a 10-year Japanese bond is at what level? Does anyone want to have a guess? Anyone? 10 years. Did I hear someone say 4 basis points? 0.04% is where you would be locking your money away if you gave it to the government today for 10 years. Why would you do it? So expect very much so that the Aussie dollar starts to go back that way as yen flows into Australia, into Canada, into America, and expect also a drag, a pull down in our interest rates. And as soon as you get that pull down in our interest rates, people say, well, look, I'm only going to get this much as a term deposit at the bank. What else can I do with my money? And guess what? That's where the stock market starts to look good again. The policy decision is just there trying to weaken the yen. There is nothing else that they can possibly do here to stimulate growth and then stimulate inflation. So what are they doing? They're beggaring thy neighbour. It's a beggar thy neighbour policy, in that all you're trying to do is steal growth from the rest of the world. So you get to sell more Toyotas if the yen is cheaper, as compared to a BMW or any other car company, a Fiat or any other car company in the world. The policy is designed to discourage capital flows, and that there is a mission that there's no other option to increase demand in your own economy. Now, if we have a look at what's happening in Japan, they have an ageing demographic. Demand is slowing naturally. They need population growth in order to turn this around, and I'm not seeing any of that at this point in time. So what are they doing? They steal demand from other countries, and that's going to continue now that they've just embarked on this policy. Almost the same situation over there, although their population is starting to grow, especially with the wave of immigration that we're starting to see of refugees. The thing is, though, is that I haven't seen anything that is turning Europe structurally. And that's the important point here, is that they're printing money. And so people are saying, well, if I give it to the bank, and over in Switzerland, for example, you're getting minus 50 basis points on your cash, which is worse than Japan, right? So what's happening here is you say, well, why would I do that? Let me go and see where else I can put my cash to go to work. And so you're getting this very low interest rate regime that's going to continue for quite a long time. Inflation is non-existent in this type of a world. Don't ever be worried that inflation is going to come back and bite us anytime soon. It is a long, long time before we should start worrying about inflation. Again, Europe's got its own problem. It's got higher unemployment. Youth unemployment is a lot higher as well. So again, when I look at that, there's going to be some continued wage pressures on the downside. It means inflation's going to go nowhere. Oil's going to help the situation. And as I've got there in my last point, it's going to be very, very interesting to see whether the ECB can actually prevent a Japanese-style debt deflation spiral. They're going to really have to step up to the plate, or if you believe that they have reached some sort of very low equilibrium, then this process of in and out of recession is going to last for at least another 10, 15, 20 years into the future. That's what inflation looks like. In the dotted line, it's below 1%, very, very close to zero, and I can't see it going anywhere now that the oil price has fallen. Growth is very feeble at sub 2%. They should be growing anywhere around 2.25% to 3%, nowhere near that at this point in time. So they really have to put their foot on the accelerator, or keep their foot on the accelerator for quite some time. Now, as I mentioned to you at the outset, Australia is still stumbling along. The economy has slowed to an annual rate of about 2.5%, and we're expecting the next number to come out pretty soon. Interesting that the reason that we've slowed down has been the mining boom, as we all know, but then once APRA came up and said we're going to up the bank capital requirements, it put a lid on house prices. Now, I was talking to Adrian at lunchtime. He said it's been interesting that the price of Sydney property has actually stabilised, come down a little bit, but the price of Gold Coast property has actually gone up. Obviously, there's been a few people that have capitalised on stronger Sydney prices and now looking to buy themselves a bit of a bargain. It's giving a bit of a tailwind to peripheral areas. Generally speaking, though, I think that there is an oversupply. I keep looking at what's going to come on stream, especially, and Dorian's not here, but when I look at what's coming on stream in Sydney and just the sheer volumes, I think there's going to be accidents happening. I read in the paper today that also default rates have gone up, nowhere near the kind of levels that they went up in the United States, but they're not on the way down, that's for sure. And so it just really is going to be a question of if you can hang on to your job, you can pay your mortgage. If you can't hang on to your job, you're in trouble. But you're not really going, and I'm not worried at all about interest rates rising at this point in time to make defaults go up through the roof. I actually think that that the default rate actually in this country is quite low. The unfortunate thing is that this feeble number of 2.5% growth, it's not enough to generate meaningful employment gains. And so we're seeing wages crunch down yet again. You know, you go back to your to the boss and say, hey, I'd like higher wages, and they'll just say, look, you know what, I can get anybody else out there. If you want your job, that's how much I'm paying, otherwise forget it, I'll just get someone off unemployment line. Now look, I don't want to be too flippant and say, you know, there's training and all sorts of things involved, but the fact of the matter is that employers still do have the upper hand. I think that there's going to be this period of the next 10 to 15 years where labour actually goes backwards. We've seen from the 1970s all the way through to probably 2007, 2008, where labour had the upper hand in this country. The return to capital is actually going to increase. Labour will have the lower hand this time, or capital will have the upper hand this time, I think, over the next 10 to 15 years. But that's just something that I've been looking at for a little while. How do I advise my kids? I say, well, get your degrees and then go and get a business. I think is the right thing to do. Let's see how that pans out. Again, it's just a very long macro trend that's occurring, and more in the back of my mind, something that I'm keeping a look at. Don't try and buy, I guess, BHP and Rio here if you're expecting to get a 20, 30, 40% return. I just can't see what's going to make the prices jump. I can't see at the same time what's going to make them fall much further than here. Off their peaks, both Rio and BHP are down 75%. which is a heck of a long way if you think about it. And what's interesting here is actually the dividend yield, although we're all expecting for Rio and BHP to cut their dividends, the dividend yield is up above 10%. So there's some bad news that's factored into those share prices. I would be very surprised if we saw a big fall from these current levels. I think that they've fallen enough. The interesting thing again is when I look at Rio and BHP in particular, and why do I pick on these two companies? Well, because they make up such a large portion of our share market. The fact of the matter is they're going to maintain that cost control. They're going to make sure that they're very vigilant in making shareholders rich. And so from that perspective, I think that they're going to control costs very, very well. They're going to be very careful with the way that they go into new projects, and I don't think they're going to be wasting shareholder money. But from here, can't see a lot of upside, but I cannot see a lot of downside either. Now, one of the bright spots, and you guys will know better than most of the country, is tourism. Tourism has been on the rise. I hear that Noosa had a pretty decent holiday season this year, and there was a bucket load of people that were walking up and down the streets, and hotels were pretty full. Education is also on the rise. I'm seeing the institutes around Sydney, which had half the people smoking down the bottom of them. These are a lot of Asian students come down to Sydney, and along York Street there's an institute just next door, and at about 11 o'clock every day there's a heck of a lot of cigarette smokers that are out the front. About 12:30 and about 3 o'clock you'll see them all over the place, and that has been absent over the last few years, as it's been actually cheaper for a lot of these guys to study in America as compared to Australia. So education is definitely on the rise. This is what the growth profile looked like in September of last year. As I said, we're waiting any day now, or any week now, for the Australian for the last quarter GDP number to come out. And if you remember, I always rave it on about GDP equals consumption plus investment plus government spending plus exports minus imports, and that's exactly what this thing is showing. The yellow is household consumption, green is private investment. The next two blue bars there are government expenditure and government investment, and as you can see, government investment is less than government expenditure, which says that we've got a budget deficit, and that's something else that's hindering the Australian economy, because they want to show that they're fiscally responsible, and so therefore they're not going to spend a whole lot of money to help the economy grow. I personally think that that's a big mistake. You've heard me say that before for those that I've spoken to, whereby they should be building more roads, more hospitals, more bridges, and so on and so forth, improving the infrastructure, because it has never been cheaper for them to borrow money. You know, these are rates where if the economy can continue to sputter along, you want to be making new dams, you want to be making new hospitals, you want to be building new schools, because funding is so cheap. And I think, as I said to you, if my view on Japan is right, it's about to get even cheaper. So, so if ever there was a time for governments to invest, whether it was power, whether it's water, it doesn't really matter, whatever infrastructure it is, they should be doing it right now, and letting the budget blow out a bit more, I think, would be prudent policy. It wouldn't be a silly policy. Exports have been helped along by the fact that the Aussie dollar has fallen, but if, as I said, if my predictions are correct and we're on the race to zero in the three major, in currency terms, in the three major areas of the world, and that's Japan, Europe and the United States, the Aussie dollar might actually bounce from here, which could actually hurt our growth a little bit. My view is that trend growth for us, and this is since 2000, and if I go back through the to sort of the 1980s, trend growth is somewhere around 3.5%. Now, a lot of people will tell me nowadays that we're actually closer to 3%, maybe just a tad below it. I'm not so sure yet. I think it's been symptomatic of the fact that the rest of the world is unable to grow and dragging us backwards with it. But the fact of the matter matter is, even if we believe that it is at 3%, we're still growing it below trend, which means unemployment has the impetus to rise and inflation has the impetus to fall. Here's the inflation picture right here, and at 1.5% CPI, which is the bar on the right-hand side on an annual basis, it really is not anything to worry about. And even if I look over the last few years, I guess, you know, there's nothing here that really concerns me. The target inflation rate for the Reserve Bank is anywhere between 2 and 3%, as you all know, and there in the middle of 2014 we hit 3% but came off pretty rapidly straight after. Retail spending, so if you go back to my chart, that yellow bar, which was nice and high and quite a sizable proportion of our economy, a lot of that is, we capture that in terms of looking at retail sales, and retail sales are around about 4% per annum. They can easily get to 6% per annum and stay there, which would represent growth closer to 3.25% to 3.5%. We're only around 4%. So consumers are fairly cautious, but again, the drop in the price of oil and petrol should help this picture. It should help this picture, which means that consumption will boost the economy a little bit. Now, that's all well and good, but it's all about the analysis. And I wasn't sure if I should hyphenate the first 4 letters of the last word here, or what I should be doing. However, it's the proctologists amongst you all would say, so what? Well, here's the so what slides. When I look at the US share market and I look at earnings, the scorecard so far is that about 40% of companies in the S&P 500 have reported to date, because we're only very early in the reporting season, and 72% of those companies have been above the average estimate, and 50% have reported. So the future, what should I be paying for? The long-term average of forward PE is about 16 times, and we're at 15 times. It just means that it's not that expensive and it looks pretty good. What we've got to worry about when we're looking at this picture is forward revisions downward in profit expectations. Now, here at 5.8% is what we've seen for the fourth quarter. Has been the decline in earnings. Again, that's probably, again, the reason why the S&P has stumbled. On top of that, the S&P has stumbled because you've had this rise in interest rates, which the markets are seeming to tell me at this point in time that it was probably an unnecessary move. The volatility is in. Now, what I did say in the quarterly newsletter for those that read it in December of last year, at least the one that Graham sent out, was that I believed that there was going to be, they had to go. They definitely had to go, otherwise they would look very foolish. They shouldn't have, but they said, we got to go, we got to go. They missed the opportunity, having given us all the thing when last year, I think it was at the beginning of last year, when China started slowing, and they just basically said, look, we've got full employment, we're worried about inflation. They should have just gone. They didn't. They said, oh, now we're going to worry about the rest of the world. They caused all this bloody angst in the marketplace, and then finally at the end of last year in December they went. When I looked at that and I said, well, they've missed the opportunity, as I said to you before, they've now come out and they said the glide path was 0.25% in December, 0.25% in March, 0.25% in June, Sep and Dec of this year. So the glide path was to get to 1.25% by December of this year. In the December newsletter, I said not a chance in the world. I think that they're going to go in December. Yes, we got that. They're not going in March, and the talk just last week, and one of the reasons why the S&P popped its head on Friday night, I think it was, by memory, by about 400 points, 397 points, was because the Fed came out and said, guess what, we might not need to tighten monetary policy in March. I reckon they shouldn't bother even talking to us anymore. Just let us work out exactly what it is that we think they should be doing, and let the market control interest rates and let them only step in when the market's got it wrong. That's not what's happening at the moment. They're going to miss March. They might go in June, but if the markets remain volatile, I'll tell you, they're probably not going to go in June. They'll go in September, and that should be it. 2 rate rises in 2016 is what we updated. I'm sticking with that call at the moment. Now, when I look at the earnings growth, when I look at what's going on in the market, there is no surprise whatsoever that the biggest negatives in earnings growth in 2015's quarter 4 was energy and materials. No, absolutely no surprise. Now, that's going to abate. There's no two ways about it. The question is, over on the left-hand side, is whether the telecom services are going to be able to have such decent earnings growth into 2016. We've seen earnings growth in the vicinity of about 27 to 28%, and a little bit ahead of expectations. The blue bar was where it is today. The grey bar is the expectations, according to FactSet. And again, it's just running a little bit ahead of where the expectations were. It looks fine. Again, if we look at Case-Shiller PEs, which looks at inflation-adjusted PEs over the next 10 years, what basically they're telling us is this skew here, that in fact the telecom services and the healthcare sector is actually skewing those PEs to look like 28. You will see some analysis from people saying Case-Shiller PEs are through the roof. We haven't seen them since the 2000s, and even in 2007 or 1999 and 2007 we're at astronomically expensive prices. This is the reason why they're pointing to astronomically expensive prices, and the fact that one sector, which makes up a large portion of the stock market, is actually pulling that average upwards. Australian forecast earnings per share, let's get back to our little monkeys. This guy's very nervous because if you have a look at the little brown line here, hopefully I get the clicker right. No, as per usual. Let me go back up. It's that one, thanks Clinton, I've got it under control. That's this one here. That's what the little monkey's worried about, and that's the earnings per share forecast for the MSCI for 2015-2016. Now, again, can I just let you know that when you're looking at the MSCI, it's only a very small subset of our market. Yes, it covers about 55 to 60% of market capitalisation, but a lot of this has got to do with resources and energy companies. So you would expect this to go on. You're expecting, we are expecting it. Can it go on more from here? As I said to you, I don't believe that to be the case from here. I think that these dividend yields that I'm starting to see on the market are starting to look pretty attractive, despite the fact that even for bank stocks at this point in time, I can't see that there's going to be a heck of a lot of growth for them. You know, dividend yields getting close to 6.5% and over 7% fully franked are starting to look okay. So, putting it all together, our smart monkey, the complex interplay between cash and currency around the world is going to dominate the picture for at least the next 5 years. Debt levels remain high, and that's going to thwart growth for as long as I can look into the future. And why? Because we used a lot of that debt to rob the future growth. I mean, you can only get to the point where every time I borrow money today to buy this laptop so I can consume it for the next little while. Once I've gone into that deal, I have to pay this off. And if I haven't paid it off by the time the silly computer buggers up and I need another one, so let's just say I've borrowed money for 4 years, the computer buggers up in 3, I'm now 1 year in the negative. If I then have to go back and borrow because I expected that that laptop was going to last me the 4 years and it didn't. And I've robbed from the future. By borrowing to consume, we rob from the future. So you've got to get that balance exactly right. Now, when the banks, central banks stepped in, they said, don't worry, we're going to make everything fine. And they shouldn't have. They should have let a whole lot of companies go broke, but as we know, too big to fail. And for those of you who haven't seen The Big Short yet, it's a fantastic movie. I recommend it, go and have a look at it. It's awesome. But the fact of the matter is that this backdrop that we have at the moment is one that is limiting growth and going to limit growth for a long period of time. As I said to you before, the Federal Reserve will raise rates just one more time. Property trusts right here, right now, despite the fact that they seem expensive yet again, if their gearing stays at somewhere around 30%, that's Westfield and GPT and industrial property trusts, if their gearing stays somewhere around 30%, I think that they're actually looking not too bad. They're giving us yields of somewhere around the 5.5% level. You know, bond yields are going to be pulled down, as I said, because of the Japanese situation. I can't see that there's a reason to want to sell them. Would I be jumping headlong into them right here, right now? Probably not. But what else do I do with my money? And that's what's going to see any pullback be very shallow and money pouring back into them. And if I have a look back over the last year, it's actually been one of the better sectors of the Australian share market and done fairly well for those of you who do own Westfield and have had a good look at it. Its share price is up about, I think I looked at it a couple of days ago, around 12%, which hasn't been too bad. But like I've got in that last point there, the share market has got eclectic value in it. There are some phenomenal companies, as you know, in the care portfolios. We've got small caps, global small caps, which are filling that void and giving us some fairly decent returns in that space. So we've got that little portion of the portfolio covered. We don't want to have too much in there. As you know, the risk in the small caps are a heck of a lot larger. But again, if you have a look at the small cap industrial index, it has done particularly well, and one that I'm absolutely favourable to. But again, avoid diggers and drillers. They are really going to burn a hole in your pocket and going to cause you no end of angst. So, coming up to my last slide, swinging or eating, at this point in time, it is eating bananas for at least another quarter. So I expect this volatility to go on for a little bit longer, but in the second half of this year I think we'll be swinging and expect to see that the Australian share market at the end of this year probably closer to 5,300 to 5,500 as opposed to 4,800. With that, it comes to the end of my presentation. I'm happy to take any questions that you possibly have for me. Yep.
Emmanuel, there's been a bit of information about these corporate bonds in the US, junk bonds and so on. Let's get your take on that.
Yeah, so if you have a look at the way corporate bonds work, they almost like a share, whereby if your profitability goes down, the chance of you paying interest on the money that you've borrowed is going down, so you become a little bit more risky. And provided that you're up to, so when you look at the capital structure of any company, bonds always rate ahead of shares, so bondholders will get paid before shareholders, but if the company goes broke, no one gets paid anything, and then you queue up on in a line and hope that you're going to get paid any amount of money before the shareholders do. What's been happening is perfectly reasonable. I think spreads got far too narrow, too compressed, and then all you needed was a spooking in the marketplace, and all of a sudden you got this widening, and the market is starting to reassess. The credit market has, though, it hasn't just completely and utterly come undone. Energy and materials have actually had spreads widen a heck of a lot more than other companies like banking stocks, for example. And so am I completely concerned that there's something systematic like 2008, 2009 that's going to happen to the credit market? No. But the fact of the matter is spreads got far too tight because cash rates were held and have been and are still going to be held too low for too long. So you need to be very, very selective in the credits that you buy in the portfolio, or managers buy in the portfolio. You just can't sit there and go, right, I want to buy every triple B rated paper in the world. If you're sitting up around the AA or A plus area, I think that's a sweet spot for now. Credit spreads, though, don't expect them to compress, especially for mining and material stocks anytime soon. Anything else? Anybody? No? All right, well, thank you very much. I'm going to pass you back to Graham. It's been a pleasure talking to you again.
Thanks, Emmanuel. I know a number of you in the room have actually availed themselves of Emmanuel's services for seminars, but as you know, with what we do, Emmanuel, Rob, myself, or any of us will